Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing position sizing part 13, the optimal F part 2. In two-tier optimal F part 1, we discussed the virtues and drawbacks of optimal F trading. In this part 2 video, we will present a methodology that will almost ensure that our initial capital is preserved with the possibility of astonishing growth factors on our trading account. This content is exclusive, and so far, you will not see it explained anywhere else. System requirements. This methodology is valid only with profitable strategies. This method is not a miracle solution for losing systems. It works best when the risk is homogeneous, that is, the dollar risk is a constant R factor to the rewards. The better the system, the higher and the smoother the rewards are. The two-tier strategy. 1. We split the trading account into two portions. One portion is 25% of the total in our case. This will be used with our optimal F positioning. The other part will be applied to a 1% risk positioning. 2. After a determined goal of up to 20 times the optimal F portion, the account will be rebalanced by adding both sub-balances together, and then resplit into a 25%-75% ratio again. This is to start a new cycle. The cycle will also reboot itself if the optimal F section balance goes below 25% of the value at the beginning of that cycle. What was the procedure to test the two-tier optimal F position system? We took the current signal table, closed the signals, and have created two 10K trading histories of what would have been 1 year of trading activity, thus resulting in two collections of 10,000 M years of trading data. One of the collection was to be used with the optimal F position sizing portion, and the other was to be employed in the 75% portion of the account. The Python code for the entire simulation is shown here. We did this procedure using several targets for the balance of the portion traded using optimal F, 2 times, 5 times, 10 times, and 20 times. We focused the results on the following parameters: average final capital, max final capital, minimum final capital, average trades needed to 10 times the total capital appreciation, average max drawdown, and the drawdown with a 1% probability of occurrence. In the table shown here, we also present the results of the 1% risk and 100% optimal F strategies. Discussion. We see that the 1% risk strategy is not bad at all, since it can multiply by 5 the initial balance in 1 year. It does that with the average max drawdown of 8.79%, with the odds reaching 16.2% drawdown on every 100 years. We also see that on average, it needs about 664 trades to multiply by 10 the initial capital. On all of our two-tier columns, we see a remarkable fact that the minimum final capital is 10,486. That meant in all the 10K years of simulated market action, not a single one ended below the initial 10K balance. Thus, this strategy seems to protect us against the loss of the initial capital. That is a terrific psychological reinforcement to withstand a high max drawdown if it presents. For the less bold investors, the use of the 2 times goal is the best choice, as this method offers an average max drawdown of 38.32% with a 1% chance of reaching a 59% drawdown. The average final capital after 1 year is $8.5 million, with a starting capital of only $10,000. This positioning strategy multiplies by 10 times the capital on average every 113 trades. The second best choice is the 5 times goal. This will be more than double than the yearly returns at the expense of near average 50% drawdown. As we can see, the more we increase the goals to rebalance, the more the account growth, but also the max drawdown will increase. We can see that these strategies' growth is orders of magnitude that lower the fully optimal F position sizing. Still, the attractiveness of this strategy is that the odds of being smaller than 10K after 1 year of trading are virtually none. Further ideas. We used 1% as the size used in 75% of the total capital in the preceding trading sizing proposals. Of course, we could modify that to better the profit from the total capital with almost no increase in drawdown and fully preserving our initial capital. You can make your own simulations on this to find what best suits you. As examples, let's present 3 more simulations using optimal 10, 5, and 2 with 2 times rebalancing goals. In the image shown here, we see that the optimal 5 in 75% of the capital will deliver huge profits with 40 to 63% drawdown figures and 79 trades to 10 times the capital appreciation. All this with almost no chance of blowing up the account. Final words. In this video, we have shown exclusive and never taught position sizing methodologies that protect the initial capital and offer vastly superior results to the 1% risk standard methodology. You must be aware that we are assuming the trading strategy is effective long term. Also, the trader will need to find the safest optimal F value by performing the proper computer simulations. That also shows the position sizing is part of a trading system that really helps you achieve your monetary objectives. For optimizing it, you need to know the optimal F of the system you are using. The market will limit the trading size. We can reach this without influencing it. But in theory, these methodologies are real wealth multipliers for a serious trader. To employ a two-tier methodology in the real market, you will need to be fully organized, have an appropriate spreadsheet to follow the trade results, have two split balances, and compute the size of the coming positions. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.